Strangle techniques to speculate in stock markets. Similar to a straddle, but the call and put have different strike prices. The strategy is profitable if the stock makes a large price move, but it typically has a lower upfront cost than a straddle. What is the primary objective of the strangle strategy in stock options trading? The primary objective of the strangle strategy in stock options trading is capitalizing on large market movements with lower costs compared to a straddle. This strategy involves buying an out-of-the-money, simply abbreviated as OTM call, and an OTM put option on the same underlying asset with the same expiration date, aiming to profit from significant movements in the stock price in either direction. The primary goal of a strangle strategy is to profit from large price movements in the stock, similar to a straddle, but with typically lower upfront costs. This is achieved by buying out-of-the-money call and put options with different strike prices. The strategy is primarily used for speculation, aiming at capital appreciation in scenarios where substantial market volatility is anticipated, but the direction of the movement is uncertain. How does the strangle strategy perform under different market conditions? The strangle strategy is ideal for highly volatile markets. It is most effective when the trader anticipates a significant price movement but is unsure of the direction. However, in markets with low volatility, where significant price swings are less likely, the strategy may result in the loss of the premiums paid for the options. Strangles are most effective in highly volatile markets where significant price movements are expected. This could be due to major corporate events, economic reports, or other market-moving news. The strategy is less suited to stable markets where large price swings are unlikely, as significant movement is needed to overcome the cost of both options. What risk is associated with the strangle strategy? The risk associated with the strangle strategy is limited to the premiums paid for the call and put options. While the strategy offers potentially high rewards, the trader risks losing the entire premium paid if the stock price does not move enough to make one of the options profitable. The risk in a strangle strategy is limited to the total premiums paid for both the call and put options. If the stock price does not move significantly, the trader may incur losses equal to these premiums. However, unlike a straddle, a strangle requires the stock to move more substantially to become profitable, given the out-of-the-money position of both options. What potential rewards can be expected from a strangle? The potential rewards from a strangle include significant gains if the stock experiences large price swings in either direction. The profit potential is theoretically unlimited on the call side and substantial on the put side, up to the point where the stock price drops to zero. The reward potential with a strangle is high if the stock experiences a large price move, either upwards or downwards. The best case scenario is a significant surge or drop in stock price, exceeding the strike prices of both options, which can lead to substantial profits. However, traders should have realistic expectations about the likelihood of such movements and consider the average expected returns. What are the key implementation steps for a strangle strategy in stock options trading? Key steps in implementing a strangle strategy include selecting suitable strike prices for both the call and put options, which is usually out of the money, otherwise known as OTM, choosing the right expiration dates, and timing the trade based on market volatility expectations. It's also important to monitor market movements and adjust the strategy as necessary to manage the positions effectively. Effective implementation of a Strangle strategy includes identifying stocks or assets likely to experience significant volatility, buying an out-of-the-money call option and an out-of-the-money put option, both with the same expiration date but different strike prices. Choosing strike prices based on the expected level of price movement and market analysis. Monitoring market events and price movements closely, as timing can significantly impact the strategy's effectiveness. Being prepared to act promptly following substantial price movements to maximize potential gains. A Strangle strategy in stock options trading is suited for traders who expect dramatic movements in the stock price but want to reduce the upfront costs associated with a straddle. It requires a keen understanding of market dynamics and the factors influencing volatility, offering the potential for high returns with controlled risk. Let's discuss the iron condor to speculate in stock markets. An advanced strategy involving 2 put options and 2 call options with different strike prices but the same expiration date. This strategy profits from low volatility in the underlying stock. What is the strategic goal of the iron condor strategy in stock options? The strategic goal of the iron condor strategy in stock options trading is profiting from low market volatility.